Well, Dawn saw an 89% jump in first half headline earnings per share to 38 cents. The distribution and warehousing group attributes the rise to a much lower cost base. Revenue increased by 10% to 2.3 billion rand. And joining us now to chat about the numbers is Derek Todd. He's the CEO of Dawn. Derek, thanks so much for joining us today.
Thank you.
Well, looking at the headline numbers is certainly impressive. Let's take a look at what's been driving momentum here, because last year this time a lot was attributed to the restructuring that the group has seen, and those kind of thoughts are echoed yet again.
That's correct. I think fundamentally there's obviously a strong degree of infrastructure spend, and we've seen that consistently over probably the last 12 months.
Mm-hmm.
Now, with the cost base that's been cemented over the last period of time, we obviously see now any form of increase in volume over the cost base immediately transfers to PBIT.
Yeah.
So the profitability of the group is now highly sensitive to little increments in growth. But certainly this has been driven by infrastructure. The building side of the business still remains relatively quiet, with building plans passed up about 21% currently off a low base.
Mm-hmm.
So we anticipate in the next 6 to 12 months seeing some expression of the increase in building plans passed.
Okay, so optimism filtering through there, where we haven't had many optimistic about the infrastructure space as a whole. We'll be getting into that landscape in just a bit. Before we do, let's just put the focus on that lower cost base being cemented that you touched on there, because many are struggling to get this right, get a handle on escalating costs. Run us through how you're managing to successfully pull this off.
Well, I think fundamentally we started this business model in the full extent in 2002, running up to 2008. And to actually have seen the financial crisis coming was a difficult task for many people.
Mm-hmm.
So we had a reasonable run up to 2008, and businesses were performing. Obviously, it's very difficult to go to the CEO of a business and say to him, "We want you now to cut your costs," whilst they were actually performing. So this all arrived with the financial crisis, as it did to all businesses. We then fundamentally climbed into the businesses and started taking the cost out. Now, that resulted in obviously certain number of retrenchments and restructuring of cost. That was all done and amounted to a total of about 200 million rands that was taken out of the business. So it was a significant change. We continue to watch costs, and we're going to all have to continue to watch costs for, I believe, some time to come. But the way we've got the model set now, we've got the businesses structured correctly from a manning point of view. We've got our manufacturing businesses that the economies of scale with the volumes that are currently going through are highly sensitive to generating profit.
So when it comes down to it, how much of the numbers that we're seeing today are a result of the actual business, and how much as a result of you becoming leaner and meaner, effectively speaking?
Well, I think a fair portion, probably somewhere in the order of 35 to 38% comes from just the cost adjustment. So it's had a significant impact on the actual. It just outlines the sensitivity of the model.
But it highlights as well that business itself is growing. So let's take a look there, because you alluded to it a little earlier, where you're seeing this cost improvement come through. You're managing to see profits come through as well. How competitive are you right now from a pricing perspective, if you're assessing your competitors out there?
If one looks at it, you look at our gross margins in all businesses, we've actually grown them. Now, that comes as a result of obviously improvements in factories and volume that has picked up, certainly in the infrastructure side, and less so in the building, but there is a volume pickup in certain major businesses of ours. We've been through a very difficult period from 6 Rand 63 to the dollar to now 9 Rand 24, I think it is currently running at today.
Mm-hmm.
There's been a lot of product dumped on this market out of countries that are exporting their unemployment into this country. And when you dump product, all you do is you erode jobs. What has happened is these countries' currencies are actually not valued at the point that they should be. So not only do you have dumping, you have incentives to export, and you are eradicating jobs. And I get a sense, what I read about government, that they are starting to take serious note of this. Now, the rand, no one can control.
But for now, the weakness working in your favour.
The weakness is in our favour. Obviously, the strength differently. So there's a lot of change coming in business currently in respect of the weakened rand. I think perhaps it's starting to get a little bit weak now, but certainly upwards of the sort of, what are we saying, 9 rand 20 is probably the place to be.
Okay, well, let's take a look at your cash flow management here, because it's cash flow management resulted in a 46% improvement in the cash generated from your operations. Having said that, your gearing ratio is sitting at 13%, and that reflecting a very healthy financial position. It's far below your bracket of 30 to 50% that was set by management. So what kind of capex spend are we looking forward to? Where are you looking to put this capital to work moving forward?
Well, I certainly believe we've got our gearing and our business down into the right position. Well, whilst we built this business, our gearing was obviously at elevated levels. When the crisis hit us, obviously we had a lot to deal with, and we've managed to do that, firstly. Secondly, if one looks at Dawn and the progress that we need to generate growth going forward, we have got capacity in most of our manufacturing facilities, except in perhaps the infrastructure side. And there's a limited capex requirement for that, because there are certain bolt-on things and certain plant pieces that we need to make sure that we can continue to grow and deal with the volumes in that area, which is showing some significant growth at the moment.
When you sat down, I said to you, quite an impressive set of numbers, and you said there's a long way still to go. What's that road ahead looking like right now?
I believe that the world is extremely pessimistic at the moment. If one looks at the US housing market, because right now in Dawn, infrastructure is showing the right numbers. Building is still, due to the stressed consumer, is still in a relatively conservative area, notwithstanding that 21% increase in building plans passed. But if one looks at the US housing market, there's quite a radical change, and it's happened rather quickly. So I think our view is we're going to see some change starting. It's all about the banks and their approach on mortgage bonds. But we've got an enormous need in this country for every element of, firstly, the individuals' homes, as well as infrastructure, hospitals, clinics, and various other infrastructural items. So if one looks at that, and you look at the fiscal requirements to do that, I believe the money is available. I think there's just a lot of caution in a lot of areas not to want to spend that money right now. We know the banks, we're looking at mortgage bonds as being too long with too low a yield. Now it's all about the housing price. And the housing price is starting to move up toward the mean level at about 900,000 rand per unit. So we're moving up in the right direction. That housing value translates into a balance sheet item for the consumer. So if there's a higher house value, obviously the whole game plays in favor of the building industry.